Hello, everyone. Thank you for joining this session. This is slot number 1 of our monthly market session, during which we aim to provide you with high-level updates on what we have seen going on in the beautiful world of B2B software and technology. Today, we'll be covering market action that we've been seeing in the month of June in public and private markets. Today, the agenda is the same as usual, but we have a special guest. You can see a bit of a pattern. Today, we are going to dive deeper into the beautiful world of supply chain software with Benoit, our topic leader on the space, who has done some work deep and wide as well, and who will share some insights of what we've been seeing in that specific vertical of software and technology. But first, before we go into this, let's have a quick look about public market performance. If we can jump to the next page, please. One after. There we go. Thank you. So this, as usual, as you know, we track a basket of just under 260 publicly listed B2B software and technology companies in North America and Europe to try to understand at a high level what is going on. You can see monthly performance at the top for June, and below you can see year-to-date 2026 performance as well. First, on the top left, you can see that we compare the performance of our basket against the wider public market indices. So S&P 500 and NASDAQ have been net negative in June, so it has been a month of correction after a strong positive push in the month of May. So S&P, NASDAQ -1 and 2.8% respectively. And you can see that the B2B software universe has been more or less in line in terms of correction in the month of June. But when you look at things on a weighted average basis, you can see that the decline is actually much stronger. This is reflected on the right-hand side. You can see when we slice and dice those 260 companies by type, you can see that there is one segment that has been down significantly in the month of June. It's the majors, so the mega caps of technology that have been hit strongly, most of them down double digit over the past few weeks. So a notable correction for that segment. You can see the rest that has been quite contrasted, but overall pretty steady or lightly negative. If we take a step back on year-to-date performance, public market indices are up, so S&P 500 almost 10%, NASDAQ 12.8%, and you can see that the B2B software universe is still in negative territory, -7%. When you look at things on a weighted basis, we're more or less even, so that is to say, technology has been trailing the rest of the public market from a performance perspective. Let's have a look at what that means from a multiples perspective with Mr. Inigo. Over to you.
Thank you, Ben. If you would move on to the next slide, please, as we look into EV sales valuations. So EV sales dipped to 4.3 times in June, which reflects the overall market, which is basically reversing the gradual recovery that we saw building throughout April and May. And when we look at it from the multi-year territory, this is still quite low, and it's levels last seen back in Q1 2017 and significantly below our 10-year average of 6.6 times. EV EBITDA valuations told a similar story, which is falling to 14.9 times after that similar partial rebound in the past months, and it's still tracking well below the 27.5 long-term average. When we move on to the next slide, when we take a look at our growth cohorts, the fundamentals remain the same when we look at performance by valuation cohort, with higher growth companies valued at higher multiples. So all cohorts are down year to date, with high growth at 7.5 times, mid growth at 3.7 times, and low growth at 2.9 times. Moving on to the next slide. For our Rule of 40 segment and for the B2B software universe, as many of you might already know, we base the Rule of 40 on the revenue growth and free cash flow margins. So when we take a look at our Rule of 40 or above, this is currently valued at 7.2 times on average, which is down from 7.6 times last month. Much lower valuation for our Rule of 20 to 30 cohort at around 3.2 times, and even lower for below Rule of 20 companies, which is now trading at around 2.9 times. Moving on to the next slide, where we look at growth versus free cash flow margin premiums. So since May 2023, and this is something we've been tracking for the past months, is that revenue growth has traded at a significant premium to free cash flow margins. And this peaked way back in March 2025 at 77%, but this has now compressed to 17% in June. So while the market still values that top line expansion, this premium relative to cash flow has clearly continued to normalize. And when we're looking at it from a regional perspective, so US versus Europe in the next slide, the valuation gap still held steady at 93% in June, which is more than double the 10-year average premium of 46%. So both regions, however, did dip. North America to 4.9 times and Europe to 2.6 times. So that compression is happening across both regions. But when we're looking at why the premium is much higher for North America, this can be explained by the higher growth numbers, which is currently at 12%. Now, moving on to the macro backdrop in the next slide, the narrative have shifted quite meaningfully within the past month. So headline CPI did climb to 4.2% in May, which was up 3.8% in April. So energy costs continue to be that primary driver. And when we look at core CPI, which strips out food and energy, this also did tick up a little bit more modestly to 2.9%. So when we're looking at the underlying pressure, this is concentrated in energy rather than the broader scope. On the policy side, the Fed has held the rate steady for a fourth consecutive meeting, but the ECB actually moved first. So they broke their holding pattern and raised rates around 25 bips or basis points on June 11, which brings the deposit facility rate to 2.25%. And this is their first hike since 2023, since the Eurozone inflation accelerated to 3.2% in May. So we're seeing both central banks pivoting towards some tightening in response to the energy-driven inflation pressures. So that's it for me on the valuation side, and I'll be giving it over to Benoit to talk about the supply chain software segment.
Thank you, Inigo. All right, so the objective is for me to give you in the next 10 minutes an overview of M&A activity in supply chain management software in 2026 year to date. Also comment on AI deployment maturity for current customers, and finally assess AI disruption risk in more detail for this space. Before I do so, I think it was for us to briefly define the four software categories that I will be discussing on this slide and lay out to you how we think about supply chain management software in general. First, we have supply chain planning upstream, which allows companies to forecast sales and optimize inventory and production planning. Then in the supply chain execution layer, we have WMS, TMS, and fleet management respectively. So warehouse management coordinates a site-level warehouse operation, including inventory management and warehouse administration. Transportation management systems are focused on transport assignment by allocating transport orders from shippers to carriers. Fleet management systems are focused on vehicle fleets management through telematics-based tracking, route optimization, driver compliance, and many vertical features. Finally, we also include global trade management focused on customs clearance and supply chain risk management focused on traceability and ESG in this space. And these we include as horizontal compliance activities throughout the space. Let's talk about M&A activity now. So overall, we tracked 41 transactions across North America and Europe year to date, with a notable increase in deal volume from Q1 to Q2 2026. Corporate M&A still accounts for the bulk of the volume, with more than 40% of the total. Overall, the key message I want you to have in mind for this slide is that deal activity in supply chain management software remains healthy, and AI is accelerating, not slowing M&A activity. If we go over each sub-segment in a bit more detail to understand the relative activity of each subspace within supply chain software. First of all, we have supply chain planning, which we see as being the most active with 11 deals in total since beginning of the year. This is due to the large addressable market of this subsegment and the strong applicability of AI to forecasting and decision support. Most deals are really focused on VC/growth funding here. Then if we look at transportation management, it remains highly active. Here, platform vendors are continuing to consolidate the space. One deal that is worth mentioning here is Project 44, which is a leading transport visibility platform acquiring LunaPath.ai to expand its visibility features with agentic AI. Now, if you look at warehouse management, which we see at 7 deals in total since beginning of the year, it attracts slightly fewer transactions, but remains highly attractive due to sticky mission-critical software, which has very high customer retention. Here, a couple deals worth having on your radar. The first one is IFS acquiring Softion to add WMS to its industrial-focused ERP platform. And the second one is Cinven acquiring a minority stake in ongoing WMS. And this is a cloud-native SMB-focused WMS based in the Nordics. Finally, in fleet management, one interesting thing that I wanted to mention here is the Respida Capital acquisition of Teletrack Navman at 220 million valuation. And this is a US-based provider of a fleet management solution called TN360. Concluding on 3 key findings that I want you to have in mind as we go forward. The first one is that software platforms are continuing to drive market consolidation through corporate M&A. Incumbent software vendors are acquiring AI native point solutions rather than building AI in-house. Private equity exits and deals are also active in this space, with the couple notable deals I have mentioned and Teletrack Navman being the largest recorded for the past quarter. Finally, VC and growth funding in this space remain concentrated on AI native platforms, such as Tord, which was a Series F at $3 billion valuation, or a physical AI platform like Mitra, which is really focused on warehouse automation and integrating AI into warehouse automation. We can now move on to the next slide. So to further deep dive on current AI maturity and key use cases being implemented in this space, I will present to you survey results from the Dedale Intelligence Global Supply Chain Survey, which was conducted in January and February of this year with 82 supply chain software decision makers. Respondents include shippers, carriers, and also logistics service providers to really get a full sample of the supply chain decision makers. The objective of these 3 questions that you see here was to assess current AI deployment maturity across the 3 execution softwares, namely transportation management, warehouse management, and fleet management, and also identify the key use cases which are currently being implemented by customers in their tech stack. Overall, the key finding I want you to have in mind is that across every segment, around half of respondents are already implementing AI solutions. Another 30% are planning adoptions over the near term, leaving only 15 to 20%, depending on the specific software, with no AI initiatives whatsoever underway. Apologies. If we look at transportation management in more details, the key use cases here that we see are load optimization and predictive ETA/exception management, which is really focused on transport visibility. And so the key finding here is that AI adoption in TMS is primarily focused on operational efficiency. These 2 use cases, they deliver immediate return on investment by lowering transportation costs and improving carrier service performance. If we look at warehouse management here, warehouse customers, they are prioritizing inventory optimization and intelligent picking, and we actually see most commercial cloud-based WMS solutions on the market, with probably Manhattan Associates as being the flagship enterprise product, already integrating AI into their inventory management features. Again, the focus here is therefore on improving execution efficiency within the warehouse. Finally, moving on to fleet management, the 2 use cases that the customers are primarily adopting are predictive maintenance and route optimization. Again, this use case, they generate measurable operational benefits. They reduce vehicle downtime, maintenance cost, and also fuel consumption. So the key takeaway from this slide here is that customers of supply chain management are indeed implementing AI in their tech stack, and they are doing so because it delivers measurable operational return on investment. We can move on to the final slide. So having established that AI adoption is indeed accelerating in supply chain software, the next question is whether AI native vendors can actually replace incumbent software providers in this space. And this at Dedale we define as AI disruption risk, which we assess at company level across all the software segments that we cover. On this chart, you can see the 6 key subsegments of supply chain software management that I have been speaking about, ranked according to their AI disruption score, and the bubble size of each subsegments represents actually the underlying market size. So overall, the key finding that I want you to have in mind is that across most supply chain software categories, deeply embedded workflows, high switching costs, and low tolerance for operational failures continue to protect incumbent vendors. And we therefore expect AI to expand existing software platforms rather than fundamentally reshape market leadership across all of these subsegments. Now, if we go into a bit more detail and we talk about each segment in more detail, let's start by the green group, which are the ones which we consider to be the most protected. And you can see that they consist of all the execution layer software, meaning TMS, WMS, and fleet management. If we look at warehouse management, it remains highly protected because it coordinates physical movement of goods in the warehouse. Operational errors are costly, switching costs are very high. A part of the market is still on-prem, meaning that customer readiness for AI adoption is pretty low. And so we estimate this to be very protected from AI. On fleet management, it also benefits from strong protection because of hardware dependency, the telematics hardware, which are actually in the vehicles, and the relatively low digital maturity of the customer persona of such solutions, which are actually truck drivers and fleet operators. Finally, on transportation management, it's also resilient because it supports mission-critical workflows that require deep integration, at the very least, with an ERP system and a WMS system. And it also offers very little tolerance for failures. I will move on now to the most exposed groups, which you see in red on the left-hand side of the slide here. We consider supply chain planning to be the most exposed and to present the greatest disruption opportunity because forecasting and optimization are highly addressable by AI in their nature. In this space, also, data is largely owned by the customers rather than the software vendors for data confidentiality reasons, which reduces the incumbent ability to train on existing customer datasets. There's also a bit of market white space, especially at SMB and mid-market level, and we estimate this white space to be capturable by AI native entrants. So to conclude on this, the greatest disruption opportunity in supply chain software lies in supply chain planning and also in risk management, while the execution layer, including WMS, TMS, and fleet management, remain well protected by workflow integration, high switching costs, and high operational criticality, and comparatively lower customer readiness. Thank you very much.
Thanks, Benoit. Hello, everybody. So now I will be first, before going to the deal side, as every quarter from now on, we wanted to share the activity heat map in different tech segments that we have seen the most in Q2 2026 in projects and different requests that we get on our platform. So we have more than 250 data points for this quarter. So from corporate and investors, so we begin to have some sort of interesting statistics on what is happening in the transaction world, both in North America and Europe. If you remember, in Q1 2026, we saw a lot of activity in GRC, so governance, risk, compliance, office of the CFO, and vertical segments such as construction and financial services. This time in Q2 2026, actually we have seen even more activity in governance, risk, and compliance segment overall. So it's the most hot segment out of all segments that we have covered, and we include as well legal tech in the GRC space. And it is closely followed by industrial and engineering space. The data and intelligence, human capital management form a strong second tier alongside sustained activity in supply chain management, as Benoit just mentioned, and office of the CIO, which have become very hot in the second quarter of 2026. And finally, some niche verticals such as basically defense tech and payments have attracted a lot of interest from investors in this quarter. And so this we will do every quarter from now on. And now looking at the deals side, if you can go to the next slide, please, Rambo. So first on the PE side, PE deals in Q2 2026 are at moderate level so far, with 72 deals happening in Q2 versus double-digit number per quarter last year. Perhaps a few deals worth mentioning here, however, are first on the payments cluster. As I said, payments we have seen a lot of interest in payments, and we can see as well that there have been quite a lot of deals on the payment side. I would like just to outline one deal on the payments, which is interesting. It's Nuvei, a payment technology provider backed by Advent International, agreed to acquire Payoneer for a total equity value of $2.75 billion. It is public to private deal, actually, and Payoneer is a cross-border payment platform for SMB offering AR and AP capabilities. And the company actually went public in 2021 and now got private. The second deal I would like to outline here is on cyber defense tech. So CVC Capital Partners acquired Smith Detection for an enterprise value of £2 billion. Smith Detection is a threat detection and security screening company for aviation, port, borders, urban security, and especially defense clients. So it's defense tech. Third that I would like to outline in the PE world is Clearwater Analytics, which was taken private as well, so from public to private by Permira and Warburg Pincus, with support from Francisco Partners and participation by Temasek in a transaction valued at $8.4 billion. And finally, 2 deals on the data intelligence side as well. Sixth Street Partners invested in Kepler, which is a commodity market data intelligence platform that we talked about a few months ago, at a valuation of more than $3.7 billion. And another deal as well on the data intelligence side was with AlphaSense. So AlphaSense secured a minority investment of Vitruvian Partners at $7.5 billion valuation, and it is an AI-powered market intelligence software. So going now into the next slide. So the corporate and M&A activity, on the other hand, has been very active. And we have seen it as well with Benoit on supply chain software side. It has been very active with strong momentum on total deal amount, number of deals, and average deal size, doing well at 27 billion euros of total deal amount, an absolute record since a few years, and 221 deals done just in Q2. The 2 deals was mentioning on the corporate M&A side are, of course, mega deals or big deals. So first it's Fin. Fin provides an AI agent that resolves customer support queries across chat, email, WhatsApp, SMS, phone, and Slack. And Salesforce acquired Fin for around 3 billion euros. And Salesforce acquired the company because Fin brings its fast to deploy offerings and 30,000 company customer base to Agentforce, Salesforce agentic AI platform. Another deal that is worth mentioning on the corporate side is Cognite. So Cognite is set to be acquired by Schneider Electric for $3.1 billion from prior investors, including Excel. Cognite is a Norway-based industrial data and AI software company, develops a cloud-native platform that contextualizes operational and IT data for energy manufacturing and utilities enterprises. And it enables AI-driven analytics across production and asset management workflows. So finally, if you go to the next slide, on the VC side, it is mainly AI-related deals that happened in this quarter on the VC side. So I will leave it to Gianna to comment on the AI-related deals update. Just before closing, I just wanted to mention that on the IPO side, aside from SpaceX that IPO'd, there were no relevant IPOs to mention. So we will skip this IPO part for today. Up to you, Gianna.
Thanks, Julia. Good evening, everyone. Here's a high-level view of the AI deals for June 2026 and how the year's been going. If you could shift a couple of slides forward. Okay. First, 2026 has been a remarkable year, as we're already at 318 billion in total AI investments. We're already halfway through the year, yet we've surpassed 2025 full year total of 223 billion. So this is the biggest year on record with 6 months left to go. In June specifically, we've saw about 12.5 billion across 119 deals. That's a slight decline from last month, but still in line with the performance of Q4 last year. And as we'll see in a second, that June is quite softer due to a few mega deals. In the next slide. So let's break it down. Mega deals are basically anything that is over 500 M. And with this, these deals have gotten quite big throughout the years. And it's skewing the 2026, they make up 84% of everything invested, consisting of mostly foundational model players such as Anthropic, XAI, and OpenAI. In June, we had 4 mega deals, and together they were about 24% of the month. So just quickly running through them. First, Base 10, which is an AI inference infrastructure, raised 1.5 billion in a Series F at up to 13 billion in valuation. It's the biggest infrastructure round of the month, and it's a nice signal that money is shifting from mainly training models to actually running them. Next would be Grook, which is a developer of foundational models across audio, text, and vision modalities. This has raised around $600 million. And what's interesting here is that it just came in 6 months after NVIDIA's roughly a $20 billion deal. Next, in cybersecurity, we're seeing that Sierra has raised 600 M at a 12 billion valuation. And finally, Ramp, which is a corporate spend management platform, it was able to raise 750 million at 44 billion valuation, nearly tripling back into their AI token spend. So all in all, these 4 deals came about 3 billion. And it consists of roughly 24% of investments in June. Now, looking beyond mega deals, if you could turn to the slide, we see that in June, it brought about 10 billion across 115 deals. That's actually the biggest month we've ever recorded for deals across 500 million rather. So this category has been climbing steadily, and we're at 500 billion for 2026 so far, with an average deal size at around 83 million, which is quite ahead of last year. So the takeaway is that AI investment is generally branching out into different segments. Now, deep diving into June's investment per segment, if you could shift to the next slide. We see 6 verticals that make up 72% of the total deal value. The biggest investments were at Office of the CIO and CTO at 17 deals, and it consists of 2.5 billion. It was mainly carried by Ninja One at 344 million. Then at the foundational model level, we see it investments at 1.9 billion to be topped off by Grook, to be followed by Martech and Sales at 1.8 billion. This was led by Liftoff. Next would be on infrastructure. We've seen a race in 100. We've seen a race in 1 billion, and it's mainly led by DriveNets, while cybersecurity came in next with around 966 million across 10 deals, topped by Sierra. Lastly, on health and life sciences, we see 834 million, and it's mainly driven by new limits investments. So overall, beyond the investment numbers, we'd like to flag that there are a couple of deals that you could look into your radar, one of which is Infinity Constellation. If you could switch to the preceding slide. It's a US-based AI native holding company founded in 2025. They operate as a holdco rather than a typical VC setup, wherein they pair an experienced founder with a shared AI infrastructure capital and a back office. And they use that said synergy to be able to create a 2 trillion plus professional service market. They've raised 17 million at the holdco level, and they're running about a team of 50. Their whole idea is to industrialize how AI native companies can build a fraction of what traditional providers can charge. And what really sets them apart is what they call the shared intelligence flywheel, wherein data, pricing, playbooks all flow across the portfolio. So each company launches faster and smarter than the other. A founder can hit a revenue of about a million in ARR in a month or two. And this model has shown results across 8 companies, and it has hit an annualized revenue of around 7.1 million within months of launch. So the disruption goes beyond traditional BPOs, staffing agencies, compliance consultancies, and even generic HR, tech, and SaaS, which is quite interesting to look into in the future. Now, I would pass the floor to Miguel.
Thanks, Gianna, and hello, everyone. So moving to the earnings, which, as you all know, we report on a rolling basis monthly. So just quickly for this one, 11 companies reported earnings in June for their Q1 results. And out of these companies, their stock price performance is actually a reverse. So 9 red, 2 green. And out of their consensus, all of them beat. And we'll find out more why on the next slide. So moving on to this next slide right here, perfect. So we've listed some of the highlights on each of the company, which you can read more offline. But to sum it up, here are some key patterns we're seeing from this cohort of earnings, which we believe is super important. As you see, there's a lot of list public to private market deals now. First pattern here. So one thing to also note here is that the earnings released in June were great, but the stocks fell anyway, and this is due from the May run up. So if you look at SPX, Nasdaq from May, like stocks were just running up, and every one of these 11 companies beat on revenue. 9 of 11 raised guidance, and most of them still sort of 3 days after they released their earnings. These stocks had essentially already pre-celebrated this earnings in May, so when the actual numbers came out, even as good as they were, there was nothing left for the market to react to. Take these 2 cyber names, right? CrowdStrike and Palo Alto. Through that April to May tech surge, those stocks ran something like 90+% for their best quarter on record. But if you look at Palo Alto hitting a record high around 85 times earnings, both of them were up roughly 70 to 100% year to date. So by the time that they reported in early June, all the good news was already in the stock. So one could not nearly double a name during a 2-month tech melt up and then expect a 2% revenue beat to push it higher since the fuel was already burned in May. That's why CrowdStrike beat and raised and still dropped 14%. For this room, the discipline point is very clear. When a name has run up that hard into the print, the post earnings dip is the run up unwinding, not the business breaking, basically. The second pattern here is basically on AI again. So AI is inflating the top line before it shows up in cash. And after a May built entirely on the AI trade, the market started demanding more proof on this AI impact on the cash. So as we all know, AI is the growth engine in every one of these names. But look at what it does to the economics of each of these companies. So remember, May's rally was specifically and mostly an AI and semiconductor rally. The market had bid up anything that's AI adjacent on the promise of the on promise of additional spend. So when these companies reported and investors could finally the cost of that spend, their patience basically ran out. One story to tell here is Oracle. It's the whole story in one stock. Infrastructure revenue up 90%, multi-cloud database up 400%, backlog over 600 billion, which was a strong growth quarter. And the same release showed full year cash flow of negative $23.5 billion, with a plan to raise roughly 40 billion more in debt and equity just to keep on building. Last pattern here, last but not the least. So beneath all of these may melt up, demand was quietly narrowing down to the biggest customers, basically. And that same concentration was what made the rally itself fragile. So across every segment, growth comes from the same place, big existing customers buying more, not really new logos or not small businesses. GitLab says it here. So six-figure accounts grew 18% and now make up over 3/4 of the revenue, offsetting that mid-market and small business pressure that's they're facing. So that's a company telling us the bottom of the market is soft and the whales are really carrying the quarter. Likewise with Sprinkler here, right? It was one of the stock in the deck that actually rose, and notice why. It's not on growth, only 7%, but on retention through a program that they built entirely to defend the top 900 accounts that are 90% of its revenue. And the healthy version of that same mechanic is Samsara and Viva. Samsara with 96% of big customers on multiple products. Viva ripping off Salesforce out of big pharma. And basically, to recap and synthesize these three patterns, they're really just one story told from three angles. The stock fell because the run-up in May had already spent the good news. AI names got repriced because investors finally asked to see the cash and what's the impact of that, not just the growth. And underneath all of it, demand is quietly concentrating into the biggest customers while on the mid-market and lower SMB market softens. And to put it together, and the picture is this: businesses are strong, the stocks are tired, and the customer base is narrowing. And for a room like this, that means the opportunity right now isn't chasing what's already run here. And what's left is picking through these names where fundamentals are still strong, but the stock hasn't caught up yet. So those are just the three main key patterns here we've observed on this remaining batch of earnings released in June for Q1. And we'll keep you updated on the next ones for Q2. So don't forget to sign up for our next session.
Thank you for joining us live today. Hope it was informative and useful. Don't hesitate to get back to us with questions and feedback, and looking forward to seeing you again in the next few weeks. Until then, all the best. Bye-bye.